Well, where is China's economy heading in 2016? That's a question most investors are asking. A recent conference in New York brought together a group of experts who may have some answers. CCTV's Karina Huber was there.
A group of China watchers discussed the year ahead for the world's second largest economy from a Wall Street office tower in Manhattan. Growth estimates vary wildly, but Justin Yi-Fu-Lin, former chief economist of the World Bank, believes growth in China will hit government targets of 6.5% this year. That is a big drop from the double-digit growth of just a few years ago, but Lin says it shouldn't be a deterrent for investors.
Even with 6.5%, China contributes to about 30% of global growth. And I think that as China is the rapid expanding market, then foreign investors, they will happy to tap into the potential.
But with the depreciation of the yuan, China is facing record capital outflows. And Lin says interest rates in the United States, which are expected to rise this summer, could exacerbate things.
The interest rate increase in the U.S. certainly will contribute to certain capital outflow from the developing country. And that will put a downward pressure on the growth in the developing country.
China's stock market, which was shut down twice in the first week of trading, rattled investors around the world. But most do not expect the stock market to have much of an impact on China's economy because the amount of money invested in stocks is relatively small.
Although we can see a lot of volatility in the market, but that won't have a big impact on the economy as long as this volatility is controlled and not spread to other financial markets.
For others, China's biggest problem has less to do with numbers and growth targets, but quality of life issues.
The pollution issue it affects everyone. It affects the leadership, it affects the rich, it affects the poor, it affects the migrant workers. There is no one who escapes that pollution.
China faces a tremendous number of challenges as it heads into 2016. But experts say that is to be expected of an economy that is in transition, moving away from one that is driven by exports to one fueled by consumer spending. Karina Huber, CCTV, New York.
Well, CCTV's Richard Bestick recently talked to a senior economist at the World Bank. She says investors shouldn't worry too much about the recent market volatility or the economic slowdown in China.
It reminds a little bit of last summer, where there was also a sharp stock market correction in China. And last summer also, the authorities monitored it carefully. They took steps to calm markets as appropriate. And the impact on the real economy really wasn't that big, because there was early policy action to calm markets. So we would expect the same to happen.
So the slowdown in the Chinese economy, inevitable and probably desirable.
Yeah, the slowdown is long planned. It's a move towards a more sustainable growth rate, and it's still a high growth rate. Even if China grows at 6.7% as we expect in 2016, it's still much higher growth rate than in most advanced markets and in many emerging markets also. And it's a deliberate policy move towards a more sustainable growth rate.